Welcome a special guest on this leg of the show. Sanjeev Prasad, Managing Director and co-head of Kotak Instl Equities, is with us on the phone line for some thoughts and some perspectives. Sanjeev, thanks for joining in. Great to have you as always. You know, a lot of people have been questioning against the rally, saying it's nothing but liquidity. But what do you make of it? And do you see any major risks on the horizon? Because the COVID risk is something the market almost seemed to be writing off.
No, I think there is some fundamental case for the rally and some, I often use the term liquidity because there is nothing like liquidity. You know, somebody buys, somebody sells. So the net amount of money in the market is always zero, and that is a separate area of discussion. But yeah, I mean, you know, the actions of central banks have resulted in, I assume, people taking a much more positive view of the future. So if you look at what has happened is, in the months of March and April, there was acute fear around the world about COVID and also the implications of COVID on the economies around the world, given severe lockdowns which have been implemented by various governments. At the same time, you had a lot of support provided by central banks and governments. And as the COVID situation started to come under some sort of control in Asia first, followed by Europe, I think investors started to take a call that, you know, hey, things are not that bad compared to how people are looking at events in let's say, in the middle of March, when, you know, the expectations was that there would be severe impact of COVID on global economies for a long period of time. We would see severe earnings downgrades and a lot of, you know, demand destruction. What we are seeing now is some of the fears receding. Primarily on the back of reopening of economies, COVID situation is coming under control. And, you know, the risk situation is looking a lot better compared to where it was. So it's just that, you know, it's essentially a change in expectations compared to the very grim prognosis which was there in the middle of March. So from there, things are looking definitely a lot better, even though in India, they still haven't got the COVID situation fully under control.
Okay, so I just want to drill down a little deeper, and you know, we were taking a look at some of the portfolio changes that you've made at your end, and what caught my eye was the fact that I think you've reduced or at least trimmed positions on some of the two-wheeler manufacturers, including Hero, and obviously you've moved allocation around. Now, I just want to understand the thought process, because one keeps hearing so much of buoyancy, you know, it's all about rural and that's where the money is. But what's the thought process here? Why have you trimmed positions on the two-wheeler plays which give you an exposure to rural?
Well, I guess if you're early to the party, you also, you know, leave the party early, I guess, right?
First in, first out.
Our view was very, yeah, exactly. Our view was pretty clear in March and April that rural India would be less impacted by COVID. You know, most of rural India, semi-urban India was not showing that many COVID cases. Also, it was pretty clear that government, when I say government, both central and state government will do whatever was required to support the rural economy. And that turned out to be the case. Whatever fiscal stimulus has been provided by the central government is largely for the rural economy. Also, Rabi crop turned out to be a decent one. Looks like we'll have a normal Kharif crop also. So we were actually quite positive on the entire agriculture input story, and we are taking a pretty positive call on two-wheelers and tractors at that time. Now we are seeing a situation where, you know, stocks have rallied pretty sharply. So as far as Hero is concerned, in particular, we are not seeing any great value in the stock now. Yes, you know, incremental news flow is positive, but, you know, it's probably getting factored in, I would say. So with just that, you know, as I said, we were early into this, made our money, so, I mean, on paper. So get out now.
Sanjeev, do you believe that, we'll come to more sectors in just a bit, Prashant here, do you believe that economies will continue to be open? We're seeing what's happening in the US, right? I mean, the number of daily rise in infections is the highest ever. I mean, it surpassed the March-April peak levels. Or do you think there is a real risk of sort of economic lockdowns once again?
Don't know, Prashant. Hard to say. You know, US and Brazil have followed their own strategies, which clearly hasn't worked out. They never implemented a very serious lockdown. So clearly, you know, there are repercussions in terms of big increases in cases. Whereas in India, we had a pretty severe lockdown in months of April and May. So we have managed to control the situation. The good news is if you see in India, unlike the US, first of all, our number of active cases are not rising that fast now. So that's a good sign. Hopefully it will peak out in the next few weeks. Number of recovered cases have far exceeded number of active cases now. So that gives you a lot more hope that, things are under control in India. And I just hope that, you will see a lot more nuanced reaction from central and state governments, even assuming there is a spike in number of new cases over the next few weeks. Hopefully that's not going to be the situation. But what we don't want is, a full lockdown of the economy once again, because that is going to have severe repercussions for livelihoods. Anyway, the economy is just about starting to find its feet. If you have an extended lockdown and an extensive lockdown, most parts of the country lockdown once again, that would be, pushing the recovery, far back. So if you have localized cases, you have some nuanced, response from the local authorities, then I think it should be fine. If you have some, disproportionate response to, let's say, increased number of cases in a particular area, then you could have a situation where the economy gets locked down once again, and then the repercussions will be pretty severe in that case.
Sanjeev, the other thinking is that a lot of people are almost saying, well, let's just cancel 2020 in terms of, it's unprecedented crisis happened, growth will take a big knock. Well, it's all known, so forget about this. Let's look at 2020, 2021, 22 financial year. And then things don't look so bad. Is that necessarily the case, Sanjeev? I mean, can we make the case that FY22 growth is going to come back very strongly? Because that seems to be the general thinking out there, that forget about 2020, we all know what has happened and the damage it will cause, so it's not a surprise. Let's look at the next year.
Yeah. Well, I guess that's what the market is looking at. That was the point also I was making earlier, that things haven't turned out to be as bad as what was assumed in March and April, when things were looking really grim in all parts of the world. But now you have a situation where Asia is more or less out of the problem, and I say Asia, that is Far East Asia. Most economies have opened up fully. Western Europe is also in a similar situation. All the economies are back to normal levels of activity. What I mean by that is, economies are reopened, and then obviously it will take time for all the economic activity to come back. US will take its time, I guess, given they still haven't been able to bring the situation under control. Now, as far as the market response to this is concerned, in a way, it's also the right one, because if you break down the market response across three categories, you have seen in the first category, where I would put items like agriculture, imports, consumer staples, pharmaceutical, telecom, stock prices have gone back to pretty much pre-COVID levels in most cases. In some cases, they're above pre-COVID prices. And there, the assessment is that, demand will not be impacted that much during lockdown and also after lockdown, and which has been the case anyway. So it's pretty much life as normal for for companies who are in that segment. Demand is holding reasonably fine, so that's okay. So now you look at the second category, where obviously there was a lot of demand destruction during COVID, but you would see a reasonably quick recovery, which we are seeing now. Items like two-wheelers, low-ticket consumer, discretionary items, healthcare services. I assume, you will see a reasonably quick normalization of both supply and demand over here. I don't think demand is going back to, pre-COVID levels in a big hurry, but it will probably stabilize somewhere about 80 to 90, 95% of pre-COVID levels for over the next few months. March 22 should hopefully be the normal year for most of these products. And the third category is, where you are seeing stock prices languishing, and there you have a lot of uncertainty with respect to demand, especially for investment areas, given the fact that, balance sheets of companies have got hurt. Also, incomes of households and governments will get hurt. Tax revenues will go down significantly for the government, so the ability to invest is reduced, and also the willingness to invest is reduced. So clearly, any new investment gets pushed out. Anyway, we had a pretty weak investment environment going into COVID. So that part of the economy will take much longer to revive, and the market is accordingly, not rewarding the stocks. You're seeing many of the stocks still trading at big, discounts compared to the pre-COVID levels. And I would also put some part of the financials in this category because they still have a lot of uncertainty with respect to the eventual level of NPLs and credit costs for banks and NBFCs. Most of them, if you exclude the top quality banks and a couple of NBFCs, most of them are trading at less than one-time book. And obviously, the market has serious concerns about the eventual level of slippages and loan loss provisions, which one have to factor in. So if the economy starts reviving fairly quickly, things, could come back in the third category, but we'll have to wait and see. 30 days over there, to be honest with you.
Okay, Sanjeev, we'll just come back in a bit. We have to take a mandatory commercial break. So very interesting sort of color and texture across what you're seeing out there. We'll take this conversation forward with some specific sectoral questions on the other side. Stay with us.